Capital Record is moved starting June 9th. New episodes of Capital Record will be on our YouTube channel. Click the link in the description to subscribe so you don't miss an episode. Capital Record, where we defend free enterprise and capital markets because we believe in the dignity of the human person. Hello and welcome to David Bahnsen's Capital Record, brought to you by National Review. And today we get to do something that is right in the strike zone of what Capital Record exists for. It is this rare opportunity where I'm going to geek out on financial markets, financial products, things that are right in the heart of capital markets, which I love to defend, and yet to do this in the context of the first principles that drive our love of a free and virtuous society here at Capital Record. Let me restate this. I have a podcast called Dividend Cafe that I do every week where for, what is it now, 17 years between the written market commentary, podcast, now video. The podcast video are not that old, but have been around for a long time. I'm talking about investments. I'm talking about financial markets. It's a much less ideological offering and very specific into what we do at my company. Capital Record does not exist for that purpose. It is here to defend financial markets, to defend free enterprise, but towards this broader vision of a free and virtuous society that we believe is the right preconditions to human flourishing. I talk about this all the time. I'm never going to stop talking about it. But what I mean by a combination today, a sort of synthesis of these things, is that there are financial products, which is not the same thing as saying investments or a particular stock or a particular money manager or whatnot. It's not an investment opportunity. It's a sort of innovation in capital markets that then I get to use today in the context of talking about first principles and making some broader points that are much bigger than the mere discussion or description of a financial thing itself. Let me eliminate the mystery. I have nothing from an investment standpoint, positive or negative, to say about this idea of SPACs. And what that means is single purpose acquisition companies, which I think the vast majority of you, not all of you, but the vast majority of you have probably never heard of. Certainly don't spend any time thinking about. I spend almost no time thinking about them because it is not something that I generally view as a necessary investment approach. But saying someone likes SPACs or doesn't like SPACs is like saying, you like food or don't like food. You go, yes, I love food. And they go, oh, you love peas? You go, no, I hate peas. You go, wait a second. You said you love food and peas are food. Therefore, you love peas. But of course, what it means when they say they love food is that they love the foods they love and they don't love the foods they don't love. And this is not very complicated. Someone can love cars and really like Fords and not like Hondas, and so forth and so on. I myself love sports, but I can't stand hockey. I think we could kind of understand what I'm getting at this point. When I talk about a SPAC, when people say, like, do you think IRAs are good to invest in? And I say, you don't invest in an IRA. An IRA is a tax treatment of a particular account type that then the things you put in the account are either good investments or bad investments. And so the reason I'm using SPACs today in an example on an ideological podcast is that this is a classic case of those whose real enemy is free enterprise trying to take down, using one example of a financial product that they don't like and trying to throw the baby out with the bathwater. Now, what they'll do, and I've brought this up a lot with private equity, they'll bring up a company that private equity put a lot of money in, put a lot of debt on. The company ended up failing, and they go, see, private equity is a failure. Now, that barely gets any credible attention because it's just so gosh darn stupid that really some of the dumbest people on the planet know that doesn't make any sense, because it is just pure cherry picking a few losers and ignoring the vast majority of outnumbered winners over losers. But with SPACs, special purpose acquisition companies, I'm about to explain what they are, I would imagine that there are lifetime more that have, if you were to look at the total cumulative return, be negative than positive. I don't know that for sure for reasons I'll explain. I don't care. But my point is that what is going on with SPACs speaks to a much broader issue. William Cohen, writes at Puck, but is a best-selling author. He's written a real authoritative book on General Electric, on Goldman Sachs, on Bear Stearns. I'm not going to lie. I absolutely love the guy. I love reading him. I love his books. I love his column in Puck. He's a diehard lefty. He used to be an investment banker, kind of a mid-level guy at JP Morgan, but he wrote for Vanity Fair for years. He's just a very good writer. And he leverages a Rolodex to try to have a sort of insider approach to things. And I don't know him personally, and he doesn't know me. I do not think he'd like me because of my politics, but I like him despite his politics. That's just sort of how I roll. He, in a column on Puck lately, had talked about SPACs being one of the most odious products Wall Street's ever devised. Now, let's stop for a second. Do you just, first of all, believe that everybody on Wall Street, meaning investors and those that make investment products, that this combination of people that are involved in financial products is both producers and consumers, do we believe that they are repeat idiots? In other words, they obviously can come up with things that lose money, but do we believe they're gluttons for punishment? That something is inherently and intrinsically bad, and they're going to continue to go back to the well? Just start with that and hold on to it loosely. Don't form an opinion yet if you don't want. He was bemoaning the fact that there's a little increase in 2025 on IPOs that are SPACs. Now, what this means, to get to the heart of the matter, is a SPAC is a company set up where it can go public easier than the regular process of going public. And so you can bring a SPAC public without identifying the company, but then you have a certain period of time to buy the company. You go, why would I do that? I don't want to buy a company that I don't even know what the company is. Well, then I guess you wouldn't. Although you're able to get your money back and you get warrants if they don't identify the company. So it's basically a way to raise money for someone to go out and identify the company. So why would you do it? Is if you believe in the person that's going to go out and try to buy or identify the company. And some people like Richard Branson and Bill Ackman and other high profile people, they can generate a lot of money because there's a lot of investors who would give them money to go find a company. And then there's structures in it that make it easier from an accounting standpoint, easier from a regulatory standpoint, able to go public. Now, if then bad companies are bought, like in an IRA, if somebody went and bought stock in their IRA in crap.com, and then you go, oh my gosh, IRAs are terrible, that wouldn't be very logical, would it? So a good company that goes public to a SPAC, we would call a good company. And a bad company that goes public to a SPAC, we call a bad company. Now, are there more likely to be bad companies than good companies in SPACs? Or perhaps a more fair way to say it is there going to be more speculation? Is there going to be a little more aggressive posture, which would mean maybe a lower batting average of success, but the successful ones have a higher magnitude of success? In other words, a higher risk-reward ratio. There is a possibility of greater reward, but yes, embedded more risk. All of these things seem rather obvious to me. But I want to make the broader point that when this massive movement of people say we got to outlaw something like SPACs, I don't care about them. I don't buy them. I haven't made them. I'm not on the manufacturing side of SPACs. But what you did with this vehicle was not come up with a new way for people to rip anybody off. Because ultimately, They're only getting the big fees they generate if they are able to go identify a company and bring it public. And people have a right to get out if they want, if they don't like it. And there's other warrants and things that go in. So there's a lot of benefits to it. But then if the companies that are bought and do go public don't do well, then the investors can lose money. That is exactly what someone who doesn't like SPACs should want. Because if you think just this whole thing sounds a little fishy, I want it to go away, that's what'll make it go away, my friends. If you really believe everyone loses money, then you don't have to worry about it because no one's going to keep doing it. And this is a permanent principle in financial markets. When you are worried about fraud, fraud should be illegal. When you are worried about collusion and corruption, those things should be illegal. Where you want a regulatory apparatus that doesn't allow for an unfair relationship, which is almost always between a company and the state, and yet we're always looking for more power from the state. But where you want to eliminate cronyism, we can do that. But if all you're talking about is just simply trying to eliminate loss, if you want a more anti-fragile system, a system that is more robust, a system that is developed better shock absorbers, that has developed a better resilience, that learns from mistakes, that you want losses. And if you say, no, I don't want people to get ripped off, then that's a different subject. Equivocating a ripoff and a loss is intellectually dishonest and often done so purposely. There is a massive difference between fraud, which is against the law, and loss. And where loss exists, it is a teacher. And if you believe the lesson of companies like, I think it was, there's a bunch of these garbage tech cool companies back in 2020, 21 that went public through SPACs and didn't end up making it. There were higher profile things. I think it was Virgin Space travel deal that had gone public through SPAC, went way up. A bunch of people made a lot of money, did end up coming way down. Some people lost money. That can happen outside of SPAC. It did. Do we want to say, you know what, I need to eliminate exercise bike companies going public? Well, why? Well, Peloton lost a lot of money after it made a bunch of money. But see, this is my whole point about risk assets. In addition to the gains that are made, and then, yes, the losses that are suffered, there are the lessons that are learned that make for a more robust market, a more robust economy. SPACs are nothing more than a financial wrapper that has a purpose that many companies have benefited from. And investors are not remotely obligated to participate if they don't like the risk-reward trade-off. And if there's no appetite for it because the risk-reward trade-off is that bad, then Wall Street's not going to do it. And if they're ripping someone off with false disclosures or fraud or bad accounting or other things of that nature, that is against the law. So when we go after capital markets as odious, as the problem itself, and suggest that sponsors get things for free out of it, sponsors don't get anything for free. The sponsor is a company that brings us back public, raises money, gets fees, has to identify a company, and then it gets a big stake in it and didn't have to put money in. But that is only true if the investors agree to it. This is an entirely buyer beware system. And the more losses that happen from SPACs, the more scrutiny that investors put on offerings that they participate in. So once again, I don't want to defend Virgin Galactic Holdings, every SPAC that's happened, every SPAC sponsor. But throwing the baby out with the bathwater here is more a symptom of a larger problem in which we believe that some disinterested third party with no skin in the game can centrally plan our way to better investor protection, better market protection, when all they can do is take away the lessons that will be self-discovered in a market economy, self-reinforced, while imposing a cost, while taking away the opportunity set for when something in the structure, something in the system could work. And you go, well, there's nothing redeeming in the system. Well, there's nothing redeeming in it, then it's not going to happen anyways. The only reason the vehicle would exist is if there is something redeeming. And if you say, well, 6 out of 10 times there might be a bad outcome, then that's going to get priced in. But the people that have to adjudicate these things are the people who are in the transaction. This is true of SPACs, but it's true of everything. This idea that we want central planners to say, look, we need to start banning this kind of a restaurant because it's just not very good. Well, I guess someone thinks it's good. And if they don't, the restaurant will be there anyways. So heads, I win, tails, I don't lose. But the market will discover that. You go, yeah, well, someone could lose money on the way. Thank you. These losses are part of the system in a market economy. And when we look at extreme cases, so-and-so lost a lot of money on it, let's throw the wrapper out. It is almost as stupid as saying, let's get rid of retirement accounts because someone put a bad investment in a retirement account. You could take the analogy anywhere you want, but I bring up SPACs because of where the analogy goes. It goes everywhere. Once you decide that a financial product is in itself bad because of some element you think is unfair. People do this all the time with hedge funds. I've already talked about private equity, and that is just a cartoonishly stupid generalization. Well, hedge funds will go, it's just so unfair. The fees are high. Well, who is it? Who are these people you think are paying these fees? They go, well, they're not getting great returns for the fees. Then I guess they're not going to do it very much, are they? Is it a Christmas gift to the hedge fund manager? Or was there a risk-reward decision, and sometimes it works out and sometimes it doesn't, and when it doesn't, you end up exiting the investment when you can, and so forth. But where do we get the idea that I need Elizabeth Warren or some new right writer or a left writer like Bill Cohen to tell us what's a good deal and what isn't a good deal? This is exactly where the free and virtuous society comes from. Now, all things being equal, do I want companies? Do I want people going public? Do I want private equity? Do I want SPACs that are all from more virtuous people? I do. There's going to be a lot of sinful people involved in these equations, but that's really beside the point. Where you say we need regulation, the prudential discussion level regulation is needed. I'm entirely for, but you're regulating against fraud. The idea that you regulate against the loss is simply preposterous in a risk system. And any system that takes away risk takes away reward. This is axiomatic. And I cannot believe that we haven't learned this lesson. There is no need for us demonizing great financial innovations and capital markets that there is self-correcting mechanisms for when things are not exactly structured right, when they lend themselves to a worse proposition of trade-off and risk reward. That would be price. Where there is a simple vehicle from which various transactions involving the production of goods and services can take place without anything compulsory at all. Might I suggest this is not an environment where state intervention is needed. Thank you very much for listening to David Wanson's Capital Record. Don't go out and buy any SPACs unless you've done your homework. But do go out and defend the free and virtuous society. That's going to involve defending capital markets each step of the way. Take care. Don't forget, we've got a new home starting June 9th. All new episodes will be on the new Capital Record YouTube channel. Click below to subscribe so you don't miss a beat.